good day, traders. And certainly if we look at what's been happening in the US interest rate markets and the fixed income market, it really emphasises just how important Friday's non-farm payrolls numbers are going to be. The expectations that are now built into the market are very much there for all to see. We've seen the US dollar up 6 days in a row, and that's going to be really interesting just to see how the dollar index trades, dollar Swiss, dollar yen, and certainly for me, very importantly, what's going to happen with dollar CNH, because if we can see a further push through 690 on dollar CNH, that's going to have some downside and potentially be the catalyst to push the Australian dollar through that 71 handle. So very much a lot of expectations now built into the US dollar as we go into this non-farm payrolls number that comes out at 10:30 on Friday night. Now, certainly the fixed income market, specifically if you look at the back end of the curve, has seen a big underperformance there. You've got that 10-year US Treasury trading at 318 at the moment. It's broken through multi-year highs, the highest level since June 2016. It's traded through that 312 level that we've been very much focused on. The ultra long end of the curve, the 30-year, is testing at the moment the multi-year downtrend, and certainly, you know, the fact if you look at that on a monthly chart, you can see that trading above the 100-month moving average, which has been the sort of beacon, I suppose, of where you look to sell that treasury for some time. So I think a monthly close above that level could really open up the debate whether we have seen an end to the secular bull market in US fixed income, which of course, if you had a nickel for every time you'd heard that statement, you'd be a very rich individual. But certainly the bond moves have been staggering. If you look in the interest rate markets, if you look at the differential between the December 2020 euro-dollar future and December 2018, which gives you an idea about what is priced in terms of interest rate expectations between that period, you can see that widening overnight by 11 basis points, which doesn't sound like a lot, but it is. It's a huge, huge move. And so therefore what we've been seeing has been staggering. Now, a number of thoughts behind this. One is obviously oil, and the fact is we saw a 7.9 million barrel build in the US inventory reports on that weekly basis, which is a huge number, but the oil price is still trading around 76 cents, so in that huge resilience. The idea that we are going to see $100 a barrel in US crude and potentially Brent, which will come first, is a real conversation that's been had from oil analysts are on the floors at the moment. So if that continues to gravitate higher and showing that resilience that we've been seeing, then of course that's going to continue to push yields even further higher, and those inflationary expectations moving ever higher going forward as well. So that's certainly been a driver of yields. You've seen the Italian situation appeased somewhat. It looks like in a war of words, the Italian ministry there has backed down to an extent, and they've lowered their deficit targets for 2020. So obviously all eyes on the Europeans and whether or not they're going to be infused by what they've been seeing there. And the US data has been absolutely brilliant. Okay, fine, the ISM manufacturing numbers were a bit on the weak side, and global PMIs are gravitating lower. But if you have a look at the ADP numbers, which are a precursor to obviously Friday's non-farm payrolls numbers, we saw 230,000 jobs there. If you have a look at the ISM service number, 21-year highs coming through in that. The US economy is on fire at the moment. It's doing very well indeed. But you can have a look in the subcomponents and have a look at new orders, have a look at prices paid, have a look at the employment subcomponent, and certainly you can understand why the US dollar has been moving up and people have been selling out of fixed income products. But if you have a look at all the leading indicators that we've been seeing, the ADP numbers, the jobless claims, the employment numbers from the manufacturing and also from service sector and all the other indicators that we look at, the expectations now for Friday's payrolls numbers are sky high. I would expect the consensus of 184,000. I think the market's probably positioned for a number north of that and north of 200,000 at the moment. But again, the most important situation, the two numbers that you have to look out for in this report is the average hourly earnings, which Governor Powell has indicated as one of the four numbers that he looks at there, and the market's looking for 2.8%. So let's say we get that below 2.6. Clearly the US dollar is going to come off pretty sharply on the back of that because it's had a good run, expectations are high. You need to see the market justify the positioning we've got there. So the market's looking for 2.8%. If you get a number hotter than that, it's going to really justify that the Federal Reserve are going to have to tighten again, not just in December, but a number of times in 2019. And that's not necessarily priced into the curve at these levels. The other thing you have to look at for is the underemployment level. Last month that came out at 7.4%. This is the level of employment for people who have actually given up work, or certainly the more broadest indicator that the Fed look out for signs of slack in the labour market. So if that comes out at say 7.2%, again that's going to be a dollar positive. But so they're the two numbers that we're looking at. It's not just about the headline number of job creation. It's about the actual wage growth data that we're looking at, average hourly earnings, and also the underemployment number, which we're looking for slack in the labour market. But as we go into this, we have seen the dollar up 6 days in a row. There's been a monster sell-off in the US fixed income market. It does seem that expectations are sky high, and we're going to need to see a number that justifies that. Now, I have no insight that suggests it's going to beat or miss. But certainly what we're looking from a risk-reward perspective is that the expectations are high, and that's something that you need to think about as part of your risk management strategy.